Traders, you should not trust your backtest without doing these adjustments. Welcome, traders. This is episode 14 of the Independent Quant podcast. I'm the founder and host of the Independent Quant, Luis, and I'm here to help traders turn their trading strategies into algorithmic strategies. So, that said, I am a trader just like you. I am not a FINRA licensed professional. I am not a financial advisor. This podcast and everything on the Independent Quant is for educational purposes only. I make no recommendations or advice for any type of platform or trades that you should take. All trades that you take are your own. We take responsibility for our own trades. So which adjustments do we need to make to backtest in order to fully trust it? We're going to go through 7 in this podcast. And I go into a lot more detail in the mini course at the Independent Quant. So if you haven't signed up for that, please do head on over there. The mini course is free. Just sign up, become part of the whole community and the whole Independent Quant movement, and you'll get everything that's in there. But without further ado, why do we backtest in the first place, right? We backtest because we want to make sure that the strategy works. We want to see good profitability and high returns. But like I always stress, we also want to see that the strategy is managing risk appropriately. We're not swinging for the fences all the time, causing our account to explode and be drawn down. We want nice, steady within our risk parameters. We want to make sure that that strategy is doing that, and it's doing so within, what's viable in the markets at this time. So how can we get there? The first one is we have to account for trading costs and slippage. This is always the first one because it is so simple but so easy to miss. Even though you know that you should be accounting for these, some platforms, as easy as they make it, it's usually just a checkbox. But if you don't remember to click that box, I mean, you're hosed. So here we go. So it's what is accounting for trading costs and slippage. So we all know that as we trade, we incur costs, commissions, fees, data. Well, data is not going to factor into this one, but commissions and fees and any other expenses that your broker may charge you for the cost of doing a trade. Slippage, on the other hand, is not getting the fill that you anticipate either going into a trade or coming out of a trade. It can play both ways. It can be a good thing because you may get a good fill going in and a good fill coming out. It could be a good fill coming in and a bad fill going out of your trade, or any combination of that. But we can't assume that just because we placed an order at a specific point, or, usually these happen more with market orders, that we are going to get the price that we want. Market is not that neat. There's liquidity issues. There's where are you in the order book? How many people are ahead of you to get filled? All this stuff factors in. We can simulate that, at least the slippage part, into our backtest. So many of our platforms that you're using allow you to include the costs of trading into the backtest. So usually, like I said, it's just a checkbox. What I've seen in several platforms for the slippage side of it, it lets you either enter a percentage of or a range or a fixed number of ticks or price difference from the intended entry. So what all that lets us do is it lets us see realistically how well our strategy actually performs, right? Because it may be within the risk parameters, but the profitability may go completely away and then some once you start accounting for those costs and slippage. For example, futures sometimes scales not as well as we'd like because we're charged per contract, and as you add more contracts, it creates more fees and commissions. Same thing happens at Forex. Usually the larger the lot sizes you're trading, commissions keep pace with it. They're not flat fees, right? The more volume you have, the more it costs to trade. That's how the brokers make their money. So if you don't factor in those costs and you're running your back test as your account is growing, maybe over the period of that back test, it's not taking into account the increasing fees. You could be looking at a back test and think this is a phenomenal strategy. It's, giving me great returns, great profitability. Once you put those costs in, all that disappears. It's a very easy fix on many platforms. If you are building your own platform to interact with your broker's API, then you should be advanced enough, if you're doing that, to know how to calculate how to include the costs and fees and introduce slippage into your back test. But if you're not trading through an API with your broker and you're using a broker platform, check the box or Google, YouTube, how to do that on your platform, or simply call your broker and ask them, hey, I want to make sure that I'm taking this into account. How do I do it on your platform? And they'll gladly explain how to account for costs and slippage. If you don't know what your costs are, your broker absolutely does. So that's a good way to figure out what your fees and everything is. And it's a great exercise to know, because you are running a trading business, right? At least that's what the Independent Quant is about. It's about starting your own algorithmic trade desk. Is part of running a business is understanding what your costs are. So even if you don't know how to include it into your back test, give your broker a call. It'll be an educational experience, just learning what your actual fees are for trading. The next one is avoiding look ahead bias. This is something that more advanced traders are probably going to find themselves in, because those of you trading on a platform, usually the platform, what I mean by that is your broker software. So if you're a Ninja trader, that's what I use, then NinjaTrader has its own, it's not proprietary language like some other platforms are. It is C#. They call it Ninja Script, which is just a class on top of a C# that has all its functionality in there. The platform itself helps you not fall into this trap of look ahead bias. But what look ahead bias is your algorithm is looking at the answer while taking the test. So it is trying to guess whether it should take a trade or not, but it's using information that it's already seen, which is not the way it's going to be when it's in the real market, right? In the real market, it's not going to know what's going to happen next. Well, it's possible for you to code or set up your strategy in such a way where, since you're doing it on historical information, you have all this information laid out for you, that you're looking not just from this moment into the past, but a little bit into the future and then into the past as you're going through your back test. And that's undesirable. It'll throw off your numbers. It can make a good strategy great, or a good strategy horrible, or, really the bad one is it takes a bad strategy and might look like it's a phenomenally good strategy that you should be trading. It's one of the harder things to catch, because especially if you're coding your own strategies and running it on your own platform, maybe engaging with an API, because you're going to have to look at your model and make sure that you are actually not introducing look ahead bias. For those of us that are using a platform provided by the broker, again, you should be okay. Now, next is using the survivorship bias-free data set. Again, now this is more for my more intermediate to advanced traders. Survivorship bias, what is it? So should be no surprise to anyone, right? That those of us living in a market economy, capitalism is survival of the fittest. It is the economic Darwinism of finance, right? Not all companies exist forever. Companies can exist for just a couple of years and then go kaput. Companies can exist for decades and then fail. Companies can exist for a century or more and then fail, right? Nothing is guaranteed forever here. So if you're trading something that has survivorship bias, that means that you're trading, or you're back testing companies that are currently in existence. So if you take those companies and you back test them over a certain period of time, a pool of stocks or pool of securities, whatever it is that you're doing, it's going to look really good because it's not counting all the failures that have happened over that period of time. Well, over the period of time that you're trading, there's going to be a lot of companies that are going to be going out of business, right? So you've got to make sure that your data set is robust enough to account for that, right? That there's going to be companies whose stock prices and everything are not going to be performing well and crashing, right? You just need to include all the companies that were available or the securities that were available for the period of time that you're back testing, especially if that's what you're going to be doing into the future. Now, this is more if you have a pool of companies, right? If you are putting an algorithmic strategy on Coca-Cola that's been around for, a century and a half or whatever like it's been, survivorship bias, not as big an issue. It's because you're only looking at one company. This conversation right here for this problem is for those of you that are looking at a pool of products. So you want to make sure that one way to make sure that you're combating this is by not going too far into the past, right? It still introduces a lot of currently active companies. It's excluding a lot of those that are out of the market, but it gives you a more clean data set of what is happening right now, but still including those that may not have made it. Another way to kind of deal with this is also maybe instead of making your own pool, go with a pool that's been already made, like an ETF that pulls together several different securities. I'm going to say securities because stocks gets too confusing, right? Because an ETF can have anything in it. There's bond ETFs, there's equities ETFs, but point being is those maintain a pool that is already accounting for a lot of this. So, again, big thing there. And that's more for my more intermediate and advanced traders, right? Those of you that are just getting started, survivorship bias, you're probably not trading an entire pool of stocks or securities. I need to say that, not trading a whole pool of securities that you've come up with yourself. You're probably starting at something much simpler. Number four is ensuring out of sample testing. Again, this one is now more for our intermediate to advanced traders. Our junior traders or newer traders probably won't see this one as much. This is when traders are again now curve fitting their strategies to past data. They're optimizing for these historical conditions rather than generalizing it, which is what we're doing when we're building these strategies, right? We're building a model that can generalize the information well enough so that when it gets new information, it's able to take appropriate actions. So with using out of sample testing, it sounds, usually when I talk with people on this one, it sounds or rhymes a lot with the look ahead bias that we just talked about, but that's actually not the case. This one, it's a different scenario. So what you're doing when you're doing out of sample testing is you've got 100 data points, you take 70 of those data points and you train your model with those data points. That's your in sample testing. The last 30 data points that you had, that's when you run the model, it's going to try to guess or see if those 30 data points are tradable or not. Now I use that real easy. I kind of said 100 data points. Hopefully you're using a way more than that, but it was easier to kind of express it that way than to say 70% and 30%. The thing is you want a portion of your data that your model gets trained at, but then it doesn't see this other data. So that other data becomes like the new market data for it, even though it's all historical data. But to that model, it doesn't know any different, right? It just knows that it's new data that it was not trained on. Another way to perform this is to do walk forward optimization by testing your strategy on different regimes. This one, if you're, again, connecting to an API, that is something that you should know how to do. That sounds pretty advanced if you're already making those types of connections. However, this one is good because several of their broker platforms provide this feature, which is walk forward optimization. So and again, this one is, you don't even have to know what it is. Sometimes all you have to do is click a box. It's not an exaggeration. It's really that simple. Click a box and have it perform that walk forward optimization and see how that strategy would have performed in different market conditions. And the last one here for number 4 is avoid excessive parameter tweaking, right? So simpler strategies tend to perform better than really complicated ones. Overfitting is usually when I catch myself is when I have too many parameters and I've been dorking around with as many of them as there are, right? It's easy trap to fall into, especially if you're a data nerd like I am, and I'm sure many of you are. You wouldn't be listening to this, but you've got to know when you've crossed the line, right? Because you again want a generalizable model, not a model that is overfit and is performing great on historical data, but the moment it sees real market data goes kaput. You don't want that. That's not why we're doing this. Number 5, we want to test across different market conditions. We want to test across different time periods, maybe different asset classes, and include volatility-based testing. If you're testing your strategies in a market that is very lackadaisical, not moving much, but now, we've got leaders of the free world making tweets and blowing up the world and causing all kinds of commotion out there. Hey, that's real, right? So that added volatility that happens randomly, how does your strategy handle that, right? Because you need to account for all those. Now, some of what I said, especially the different asset classes, if you are very much focused on one asset class, that's perfectly fine, right? It's nice to have multiple asset classes for diversification, but I can tell you that for myself, I trade Forex, and for Forex, I only trade Euro USD pair. Sometimes I'll look at the USD Japanese yen, but overall, I'm focused on just that one market. When I go to futures, it's typically just the equities, the Forex futures, and maybe a commodity. I haven't traded a commodity, though, at the time of this recording, and maybe in a couple of years. So different asset classes means different things for different people, right? So for me, Euro USD is my short-term money. My futures trading is more my mid-term money, and then my options are really where I'm doing a lot of my big 2 to 4 week swing trading. So not the same strategies. I'm using different asset classes. But if that's not your thing, right? And you're doing a very focused test of market conditions, or you're focused on a strategy on a specific market, that's okay. That's okay. Different asset classes will only matter if that's something that's part of your strategy. But if your strategy is amenable to others, then you want to give it a try. I think that'd be a good idea to see how it performs somewhere else, because who knows, maybe it does perform better in another asset class. So don't get too married to the asset class that you're only trading. Okay. And you want to test across multiple time periods. That means, how does your strategy perform on an intraday chart? 1 minute, 5 minute, 15 minute? How does it perform on a daily? How does it perform on a weekly? You want to know, okay, is it, how does it perform on any of those time frames when it's a bullish, a bearish, or a sideways market? Big takeaway of number 5 here is different market conditions, right? Because you are going to backtest during a period of time that you believe reflects the current market conditions, but market conditions can shift at any moment, right? So you want to know that the moment you drop it into the market, that it can at least endure something that's at least a little different from what it was trained in. Because if it doesn't, then you may have a great strategy that just got released at the wrong time. And you want to know that sooner rather than later, rather than just have this strategy out there, do whatever it does to you before you realize it's time to take action. So test it under different market conditions, help address a lot of that. Number 6 is incorporating position sizing and risk management. Now, some back tests out there, they just use a fixed position size, not really addressing how that would work in relation to the capital that they're trading, and doesn't really adjust for or account for risk management. Now, my first several strategies were that simple. You create a strategy, and sometimes it's a little tricky to code how to do risk management and how to position size into a strategy. Um, I haven't come across any libraries that facilitate that. So, the beauty of it is we do have generative AI now. You can go out there and ask your AI tool of choice, hey, how do I implement dynamic position sizing? Because that's really going to help you now control your risk that much better. You don't want to be trading a consistent position size that doubles your risk from one trade to the next. Really, it doubles your risk and puts you out of that 2% max, puts you, 2% risk per trade or more on each trade. You want to make sure that you're keeping account of that maximum drawdown, and adjusting your position size dynamically will help you mitigate a lot of that pain of having too large a drawdown. And those are the really big ones that we want to make sure that we're doing with number 6 there, which again is incorporating position sizing and risk management. And number 7, validating statistical significance, right? A lot of traders backtest with, getting high returns, and they think, oh, this one is automatically a profitable strategy. But without statistical significance, the results you're looking at may just be pure chance. So the way to assess, or at least get a gauge to make sure that your strategy isn't trading by and being successful out of pure chance, is you want to make sure that you perform Monte Carlo simulations. Again, this is a very advanced math topic. It could be that, you're all more like me that are in the STEM world. So you may have taken classes on this, so I don't want to pass judgment on who's listening to this podcast right now. But if the Monte Carlo simulation is something that's beyond anything that you've studied in mathematics, you don't have to worry so much about that. Because again, thank you to many of these broker software platforms, that is also just a box you check or a feature that you use within the backtesting platform within your broker software. And it'll run these Monte Carlo simulations, which what they do is they see how your strategy performs in different random scenarios. What a Monte Carlo simulation is, we're not going to get into that. Again, fairly advanced topic as far as what the math is, but it's just randomizing data for your model just to see how it works. So that's the big one there for validating statistical significance. Also with that is making sure that you have enough data to make an assessment, right? Central limit theorem of statistics tells us, that anything, once we have 30 data points, we can assume a Gaussian distribution. That's great. But I would not put money on a strategy that has only taken 30. To me, that's not statistically significant. You want to be able to make sure you have enough data to make an assessment. Now, on the other side of that is you can have too much data. An example of this was, Bollinger Bands. If you trade Bollinger Bands, whenever price opens outside of a Bollinger Band, riding it into the moving average, there seems to be a lot of opportunity in that. Well, you'll find that it does hundreds, if not thousands of trades, potentially a month. So that is too much information. That's over trading, right? So it's good to understand where your strategy is sweet, but when you have too little and when you have too much information to be able to manage your strategy appropriately. So That's how we build trustworthy with our back tests. Again, we want to always include trading costs, slippage, and execution delays. Ensure that no future data is included or used in our model. Use survivorship, bias-free data, test across different market conditions, implement a realistic position sizing and drawdown limits, and validate everything with statistical significance. If you follow those, you'll be well on your way to building a realistic, actionable strategy that give you a decent probability of success and will get you on your path to achieve your trading goals. Thank you so much for listening to this whole way. Head on over to the Independent Quant. If you haven't signed up for the mini course, please do. There's a newsletter on our website, and we'd love to have you sign up for that as well. I look forward to continuing this journey of building an algorithmic trade desk with you. And I thank you so much for your time. Until the next time we talk again, this is Luis. Keep it green, traders.